Okay, let's unpack this. Today we're diving into, well, the pretty complex world of housing finance. We're specifically zooming in on the Q3 2025 financial results for Fannie Mae. A huge player, obviously.
Yeah, absolutely huge. And our mission here for you listening is really to give you the fastest route to understanding the core health of Fannie Mae, operationally, financially. And we're doing that by looking specifically through the CFO's eyes, focusing just on their opening remarks from the recent earnings call.
All right, straight from the source. What did the CFO actually emphasize?
Exactly. We want to pull out those critical insights. What drove the quarter? What does it signal about, the broader U.S. housing market?
And the numbers, they definitely start big. Top-line net income was $3.9 billion for the quarter.
That's the number, $3.9 billion, which is a solid jump, 16% from Q2.
But the real engine, that guarantee book they manage,
Yeah.
It's still just massive, $4.1 trillion.
Monumental is the word. And, it's the sheer scale of that book that makes every single quarterly result so important. And while $3.9 billion is that headline figure, the CFO was pretty quick to add some context.
Okay, what was the catch?
Well, not so much a catch, but context. While it was up quarter over quarter, it was actually down about 5% compared to Q3 of last year.
Okay. So up from Q2, down from last year. And that 5% dip,
Yeah.
that's where we need to maybe dig in a bit.
Exactly. The CFO specifically mentioned that the change, that year-over-year dip, was mainly because of shifts in the provision for credit loss.
Right, the provision. For you listening, maybe explain why that provision number is such a key thing to watch. Why does it matter so much?
Well, it's a really powerful forward-looking signal. It's not just about what defaults are happening now. It's management's best estimate of potential future losses. They look at the economy, the quality of the new loans they're bringing on.
So it's like their risk forecast changing.
Precisely. When that provision number moves significantly, up or down, it tells you management is adjusting its expectations about future credit health, about macroeconomic risk. It's less about day-to-day operations and much more about anticipating risk.
Got it. So operations seem stable, but maybe the risk outlook shifted a bit, hence the change in provisioning. And despite that year-over-year income dip, net revenues were incredibly stable, $7.3 billion.
Super stable, $7.3 billion. And that stability helped push their net worth up. It's now at $105.5 billion. Quite impressive.
Very impressive.
And that stability is just critical. Plus, for the finance folks listening, there's the illustrative return on required equity. That's a key metric for capital efficiency. It actually increased this quarter to 10.3%, which, shows pretty solid financial discipline, especially given the challenging market out there.
Okay, so solid financials. But what I found interesting was the CFO quickly pivoted from those numbers to their sort of social mission aspect. Even with affordability being such a struggle, they pumped $109 billion of liquidity into the mortgage market just in Q3. That's a huge amount of support.
It's massive, and it translates directly into impact for, actual people, individual Americans. That $109 billion helped over 400,000 households.
Woof, 400,000 households.
Yeah, just to put that in perspective for you, that's like supporting more homes in one quarter than the entire population of, say, Tampa, Florida. It gives you a sense of the scale.
And they broke that down further, right? Where did that support go?
They did. So 207,000 of those were home buyers, and almost half of those were first-time buyers.
So a clear focus on getting people into homes, especially first-timers, speaks to that affordability challenge again.
Definitely. And they also highlighted their loss mitigation efforts, keeping people in their homes. Over 23,000 households got help through assistance programs just in Q3. And if you look at the year so far, the first 9 months, $287 billion in liquidity provided, helping 1.1 million households buy, refi, or rent a home. The scale is just hard to overstate.
Okay, let's dig into the business engine then. That stable $7.3 billion in revenue, where is it actually coming from? The CFO pointed to guarantee fees, right, making up almost 81% of net revenue.
That's the core, stable guarantee fees, almost 81%. It really reinforces just how strong that fundamental business model is.
Reliable income stream.
Very. And related to that, the net interest margin, the NIM, basically the spread between what they earn on assets and pay on liabilities, that also held steady, 66 basis points for the first 9 months.
Okay, quick clarification for you listening. 66 basis points is 0.66%. And the CFO noted this level is similar to pre-pandemic years, right, before the big refi boom.
Exactly. It tells you that the current margin environment is sort of normalized. It's not like those crazy high-volume refi years we saw recently.
Right.
Yeah. And here's a really key accounting detail. It often trips people up. That huge stream of guarantee fee income. It actually gets booked on the income statement as interest income.
Wait, as interest income, not fee income.
Correct. Not
Fee income.
Why? That seems odd. Why isn't a fee reported as a fee?
It's because of accounting rules. Specifically, the rule that requires Fannie Mae to consolidate the mortgage-backed securities, the MBS trusts, onto its own balance sheet. So the short version is the accounting makes them report as if they own all the underlying mortgages in those pools, even though they've transferred a lot of the credit risk away.
Ah, okay. So it's an accounting presentation thing driven by consolidation?
Exactly. It's a fundamental detail you just have to know when looking at their P&L. That guarantee income flows through the interest income line. Understood. Okay, so we know where the money comes from. Now let's talk about the market forces shaping their new business, their acquisitions. Affordability keeps coming up. It's still squeezing single-family buyers, isn't it? And it means new loans aren't fully replacing the ones paying off.
That's right. The new acquisitions aren't quite offsetting the runoff from the existing book, and you see that really clearly in the mix of those acquisitions. In Q3, 80% of their single-family acquisitions were purchase loans, people buying homes.
Only 20% refinances them.
Exactly, only 20% refis. And that heavy lean towards purchases is why the flow of deferred guarantee fees is much lower now.
Explain that deferred fee part quickly.
Sure. When people refinance, especially during big refi waves like in 2021, 2022, those deferred fees from the old loans get recognized faster. With fewer refis happening now, that acceleration isn't happening.
Gotcha. Less refi churn means slower recognition of those built-up fees. So this raises a huge question about future revenue, especially from refinances. Did the CFO give any indication, like what interest rate level would trigger more refi activity?
They were very specific on this point, and this, I think, is maybe the biggest insight for understanding their future business path. Based on the interest rates of the loans already sitting in their massive single-family book, Fannie Mae does not expect a meaningful pickup in refinancing unless mortgage rates drop below 5%.
Wow. Okay, let me just repeat that. Below 5%.
Below 5%.
So unless rates fall significantly from where they've been hovering, that whole chunk of business, the refi market, it just stays quiet for them.
That seems to be their assessment. They're essentially locked out of a historically lucrative revenue stream, those big refi waves, unless rates get down under that 5% mark.
Which means if rates do stay elevated, their whole acquisition strategy has to rely on the purchase market.
Right.
Which, as we just said, is struggling with affordability. That really changes their business risk profile, doesn't it?
It absolutely does. It puts enormous pressure on their operational discipline, on their risk management, which brings us neatly to the credit profile of that $4.1 trillion book.
Okay, credit quality. How's it holding up?
Overall, the CFO described it as relatively stable. But you really need to look at the two main business lines separately, single family and multifamily.
Right. Single family is the big one, 87% of the book. How's that looking?
Credit profile there is still characterized as strong. Though seriously delinquent loans, non-performing loans, they did tick up modestly.
Any specific reason given?
Well, interestingly, the Q3 provision for credit losses in single family was mostly driven by loans they acquired during the quarter.
So they're being cautious about the new loans coming in the door. Seems that way. They're vigilant. And they specifically called out which types of new loans they're monitoring most closely. It's loans with FICO scores under 680 and debt-to-income ratios, DTI, greater than 43%. That's where they see the concentrated credit risk in new acquisitions.
Okay, that makes sense. But they also have safeguards, right? Credit enhancements. They do. It's a significant point. Nearly half the single-family book, 47%, which is about $1.7 trillion, is covered by one or more forms of credit enhancement.
Like mortgage insurance.
Yes, including $758 billion covered by primary mortgage insurance. It acts as a pretty significant buffer, protecting taxpayers ultimately.
Okay, so single family. Strong but watchful, with buffers in place. What about multifamily? That's where the stress is more visible.
That's what the numbers suggest. In multifamily, seriously delinquent and non-performing loans increased 7 basis points just from Q2 to Q3, and net charge-offs increased 4 basis points.
Not huge jumps, but definitely moving in the wrong direction.
Right. It shows growing pressure.
And what's causing that pressure in multifamily, if affordability is the big story in single family?
For multifamily, the CFO described it as sort of accumulated pressure. It's the result of sustained market challenges hitting apartment owners and operators. Plus, more recently, they're seeing some softness in both rent growth and net operating income NOI growth for these properties.
So property owners are feeling the squeeze, and that's starting to show up in loan performance.
Exactly. The investors are struggling, and that flows through to Fannie Mae's books. However, it's crucial to note, almost all of their multifamily book does have some form of credit protection because of their risk-sharing deals and credit risk transfer, CRT programs.
Right, the risk isn't all sitting with Fannie Mae. Okay, let's pivot from credit stress to managing the shop. Cost control. They seem to do well there. Total non-interest expenses were down quite a bit.
Yeah, impressively so. Down 8% compared to Q2 and down 10% compared to last year. In this kind of environment, that efficiency is critical.
What drove those savings?
Two main things, according to the CFO. First, pretty straightforward. Reductions in administrative expenses.
Yeah.
That basically means a smaller workforce, fewer employees, fewer contractors.
Cutting headcount and related costs.
Right. Salaries, benefits, professional services. Actual dollar savings there.
And the second factor, something about other income.
Yeah, an increase in other income, which sounds a bit like an accounting bucket, but it reflects real operational factors. A big piece was gains they made by buying back some of their own Fannie Mae MBS during the quarter debt extinguishment gains.
Buying their own debt back at a discount.
Essentially. Plus, they also had lower expenses related to foreclosed properties. Apparently, they changed their strategy on how they repair and handle those properties, which saved money.
Okay, so cutting costs, maximizing gains where they can, smart moves in a tough environment.
Absolutely. And you have to see all of this, the earnings, the cost control in the context of their biggest structural challenge, building regulatory capital.
Right, that's the ultimate goal here, isn't it? Like
Yeah.
every dollar earned or saved goes towards plugging that capital hole.
That's the end game. All these strong earnings, they're just retained. They don't pay dividends. It all goes to building capital. And they have made progress. Net worth is up $92 billion since the start of 2020. It hit that $100.5 billion mark we mentioned.
Okay, $105.5 billion in net worth. Sounds solid. But then comes the big but, the regulatory gap. Despite having over $100 billion in net worth, they still report a total regulatory capital deficit. How much was it?
$25.4 billion, a deficit of $25.4 billion.
How is that possible? How can you have $105 billion in net worth but still be $25 billion short on regulatory capital?
Yeah, it's complex, but absolutely essential to understand Fannie Mae's situation. That deficit exists because, under the specific rules of the Enterprise Regulatory Capital Framework, two huge items on their balance sheet don't count towards regulatory capital.
What item is those?
The senior preferred stock held by the U.S. Treasury, that's from the bailout era, and Fannie Mae's deferred tax assets. Billions and billions of dollars that regulators say, nope, that doesn't count as the kind of loss-absorbing capital we require.
Oh, okay. So they have the assets, technically, but they don't count for the regulatory test.
Correct. They don't count as eligible capital.
And the total amount they eventually need.
Mm.
That's staggering, isn't it?
It is. So first, they need to earn enough to cover that $25.4 billion deficit they're currently in, just to get back to zero. Then on top of that, they need roughly another $190 billion in eligible capital to fully meet their total requirements under the framework.
$190 billion plus the $25 billion deficit. That's over $215 billion they need to accumulate.
The mountain is huge. It underscores why those sustained strong earnings are absolutely non-negotiable for them, and why efficiency matters so much. It's going to be a very long road to full recapitalization.
A very long road. But for reassurance, the CFO did mention the stress tests, right? The Dodd-Frank tests.
Yes, important point for context. They highlighted the 2025 Dodd-Frank stress test results. And remember, those tests simulate an economic scenario designed to be even worse than the Great Recession.
And Fannie Mae passed.
The results showed that even in that incredibly severe scenario, Fannie Mae would be able to continue supporting the housing market. That underlying resilience, even while undercapitalized by the regulatory standard, is the critical stabilizing factor they provide to the whole mortgage ecosystem.
Okay, so wrapping this up, synthesizing what we heard from the CFO's perspective, what are the main takeaways?
I think there are really two core interconnected themes that came through loud and clear from the CFO's remarks. First, just the underlying strength and resilience of their earnings power. $3.9 billion in Q3, $10.8 billion for the year so far, driven mostly by that incredibly consistent guarantee business. It's a durable foundation.
Stable earnings engine, check.
Second, Everything they do operationally managing credit risk, cutting costs, focusing on purchase loans, now it's all laser focused on that overarching mission.
Mm.
Operate safely and prudently while steadily, painstakingly closing that massive regulatory capital gap.
Right. The focus is crystal clear. Build capital through disciplined operations and risk management. Keep the ship steady while you fill the hole in the hull.
That sums it up pretty well. And, that leads us to the final provocative thought for you, the listener, to maybe mull over. We heard the CFO state clearly that the single-family book probably won't see meaningful refi volumes unless rates drop below 5%. We also heard that affordability pressures are pushing them towards purchase loans, maybe with slightly higher DTIs that need monitoring. So the question to ponder is, if this current environment of elevated interest rates persists for the longer term, what does that really imply about the long-term durability and risk profile of that massive $4.1 trillion guarantee book? What stands out to you?